here after a very disappointing.
I don't know about disappointing.
Yesterday. You were on the right side of the thing, man.
I suppose it depends on your perspective.
Yeah.
Yes, sir. It was one of the best games I've seen
really
in a long time. Yeah.
Although I slept through most of it. It was good.
You're sounding a little raspy, bro. That third shot is hurting you.
It's hurting.
Ugh.
What do you got for us this week, man?
All right.
I know you want to crack off the Army-Navy.
We'll get it going. Yeah, I mean, I was looking for some pictures to put up for Army-Navy, and this is kind of my favorite one because, at the end of the day, we're all on the same team. And, Army-Navy game, the only game where everyone playing is willing to die for everyone watching.
For sure.
Pretty much says it all. Definitely why, if of all the things we have holidays about, Army-Navy game, the Monday after Army-Navy game ought to be a holiday.
It should.
I'm just saying. I'll put that out there. Yeah.
Let's make it a federal holiday. But not for the midshipmen and cadets. They need to go back to work.
Well, so on my they have to go back to work. So I might have spent a little time on restriction when I was at the academy.
How does this not surprise me?
Yeah. Well, I got caught more often than I should have. So we were on a little, chat chain last night while the game's going on, and one of the guys that I spent some time on restriction with was talking about how when we beat Army, a lot of the times the superintendent will come out and basically absolve you of your crimes, and it's, for everybody, not just like the football team, like for anybody who's on restriction, sometimes they absolve you of all your restriction time, and that did happen when I was there my senior year. My senior year was the only year that we beat Army the whole time I was there.
You probably needed it that year.
I did. Yeah. All right, it was a good game. So this week we got two requests to look at two different things. What exactly do we mean when we talk about oversold and overbought? So we're gonna kind of dig into that a little bit, and then we had a question about what do we look at for allocation strategies in terms of 50C, 50S, 10C, 5F, 47. This how do you come up with allocation strategies? We'll take a look at that. Bonus chart. I had kicked around a couple of different bonus charts, and I'm gonna go with BRKA, which is Berkshire Hathaway. There's an A and a B. Berkshire Hathaway is Warren Buffett's company. So just because everybody talks about Warren Buffett, and who clearly is one of the best investors of all time, if you take a look at the chart of his company, it might tell you some things you would expect, right? If you didn't know any better, you might think it goes up in a straight line, but that might not be the case. And then we'll look at the 2-year weekly charts. All right, so the definitions I took here out of stockcharts.com, and we're going to go over an example here. But the definition is basically overbought is a technical condition that occurs when prices are considered too high and susceptible to a decline. Overbought conditions can be classified by analyzing the chart pattern or indicators such as the stochastic oscillator and relative strength, which we're going to take a look at. So, for example, a sharp advance from 15 to 30, so you doubled your money in 2 weeks, might lead a technician to believe that a security is overbought, right? If it goes up 100% in 2 weeks, it's probably overbought. Sometimes the security is considered overbought when the stochastic oscillator exceeds 80 and when the relative strength index exceeds 70. And here's really the thing. It's important to keep in mind that overbought is not necessarily the same as being bearish, because you would think that when a stock gets overbought, it might be time to sell it because it's at a high and now you want to sell it. Well, overbought merely infers that the stock has risen too far too fast and might be due for a pullback. Doesn't mean it is due for a pullback yet. Doesn't mean it has pulled back. Just means it's risen too far too fast and might be good for a pullback, so you want to keep an eye on it. Oversold, kind of the reverse. Technical condition that occurs when prices are considered too low and ripe for a rally. Oversold conditions can be classified by analyzing the chart pattern or with indicators such as stochastic and RSI. A sharp decline from 30 to 15, so you lost half your money in 2 weeks, let's say, might lead a technician to believe that a security is oversold. Sometimes when a security is considered oversold, when the stochastic is less than 20 and relative strength is less than 30. it's important to keep in mind that oversold is not necessarily the same as being bullish, right? Because you would expect that if one of the funds or a stock or whatever is oversold, now's the time to buy it. That's not necessarily the case. It merely infers that the security has fallen too far too fast and may be due for a reaction rally. All right, so those are the definitions, and you can get them at both of those definitions are on the same page at school.stockcharts.com. So what does it look like kind of in real life? Here's the chart pattern, the price. Here's the relative strength index, the stochastic index, and I added another one, the money flow index. So let's just go through. So the RSI, right, we talk about that quite a bit. RSI is a momentum oscillator that measures the speed and change of price movements. Okay, it's measuring the speed and change. So RSI oscillates between 0 and 100. You got basically 90 here and 10 there, but it goes between 0 and 100. Okay. According to Wilder, the guy that created the RSI index, RSI is considered overbought when above 70 and oversold when below 30. So that's why they have that line at 30 and the line at 70. So it's considered overbought at 70 and oversold at 30. So the thing to really take away is it can stay. So we got overbought, let's say right here, which is right about here in price. So it can stay overbought for a long time, and price can continue to go higher, right? So just because it hits the overbought line doesn't mean it's time to sell it. It just means price has risen relatively quickly in a relatively short amount of time, because like I said, RSI is measuring the speed and change of price movement. It doesn't mean it's getting ready to roll over necessarily anytime soon. So that's one indicator. The stochastic oscillator is also a momentum indicator that shows the location of the close relative to the high-low range over a set number of periods. It gets very mathematical, but the oscillator, it doesn't follow price, doesn't follow volume or anything like that. It follows the speed or the momentum of price. Okay? So as a rule, the momentum changes direction before price, which is why we use this as one of the potential leading indicators. So as such, bullish and bearish divergences in stochastic oscillator can be used to foreshadow reversals. As the stochastic oscillator is range bound, right? It's between 20 and 80 is the stochastic. It's also useful for identifying overbought and oversold levels. So traditional settings use 80 as overbought threshold and 20 as oversold thresholds. It's important to note that overbought readings are not necessarily bearish. Securities can become overbought and remain overbought during a strong uptrend. Closing levels that are consistently near the top of the range indicate sustained buying pressure, right? So as long as it stays up there, it's indicating sustained buying pressure, which means prices are likely to move higher even though it's overbought. In a similar vein, oversold readings are not necessarily bullish. Securities can also become oversold and remain oversold during a strong downtrend. Closing levels consistently near the bottom of the range indicate sustained selling pressure. So even though for the past year or so we've seen these V bottoms happen all the time, right? We don't so much see it in this correction back here in September. We got oversold pretty early in that September correction, and we stayed relatively oversold, for a month or two, about a month. That's why a lot of people use the 50 line as the trigger. So some of this. In this case, the 50 line, once it gets above the 50 line, you're watching it being oversold. It comes back up to the 50 line. That's a time when it's likely to get to price continue to move higher and the indicator to continue to move to overbought. So that's why a lot of these things align. Okay, so those are two. So we overlay them on top of each other, right? The third one, there's 50 indicators in stockcharts.com. They're not all range bound. They don't all indicate overbought and oversold levels, but these are three that are really good. So the third one is money flow index. It's an oscillator that uses both price and volume to measure buying and selling pressure. So overbought and oversold levels can be used to identify unsustainable price extremes. Typically, MFI above 80 is considered overbought, and MFI below 20 is considered oversold. During strong trends can present a problem for these classic overbought and oversold levels. MFI can become overbought greater than 80, and prices can simply continue higher when the uptrend is strong. Conversely, MFI can become oversold below 20, and prices can simply continue lower when the downtrend is strong. So they're technical indicators. They're not necessarily associated with price. That's why we have the price chart up top. But the idea is to overlay the technical indicators and try to anticipate which way price is likely to continue moving. These particular ones, they can tell you when price is overbought and oversold, but they're not trying to time the bottom or time the top. They're telling you when conditions are above or below average, basically, or at extremes. So let's take one more look at this. We got to overbought here on the stochastic. Actually, let's pick a better one. So money flow, for example, didn't get to overbought, but it peaked out right here. Slow stochastic had already gotten overbought, and RSI hadn't gotten overbought yet. So we're looking at all these things to try to kind of get an idea, and price, hadn't topped out. It had just come off this little dip below the 10-day moving average line. But back here, you got the stochastic hit overbought. RSI was just above the 50 line. And you got money flow turned positive, but nowhere near overbought yet. So that's the beginning, right? And then as things get more overbought, we get closer to the top. And we're running along the 10-day moving average line. So you're taking all these things into consideration to try to make reallocation decisions. That's what we do. Okay. So hopefully that helps with what overbought and oversold actually is and how we use it. So allocation strategies. Generally speaking, I try to make this as simple as possible. I mean, there are all kinds of ways to play the game, but generally speaking, the stock funds rise and fall together. Okay. So if you want to do like a maximum diversification model, I think ideally you would be in all three of the TSP stock funds when the overall market's trending up, and you want to be, protecting those gains when the market's trending down. But let's not worry about that for now. So, but you will get divergences between the three, right? So on any given day, the C fund can be up, the S fund can be down, the I fund can be flat, like whatever. So if you're trying to pick the one of the three that's going to be up on any given day, that's not something that I think is reasonable to try to do. So why not? Here's a comparison chart. We're gonna look at a few different ways of looking at this, but here's a comparison chart that I did on stockcharts.com. So from 2019, you can see the I fund is blue, S fund is gold, and the C fund is the regular daily chart, which is black and red. So this chart, they're not compared to each other. It's not like a percentage comparison to each other. Obviously, the I fund has not outperformed the other two stock funds in 2019, right? That's not what this is saying. It's just a chart that overlays all three so you can see like a visual representation of it. They all generally move up and down and up sideways. They all basically move in the same direction together. So if you want to be diversified, just be in all three stock funds when the market is trending up. Obviously, when the market's trending down, you don't want to be in any of the three, right? There's no value in being in any of the three stock funds when the overall market's trending down. On an annual basis or a shorter term time frame, in this chart you can see the C fund kept rolling higher all the way through 21. The S fund in gold hit a top here in February and it's basically gone sideways. The I fund hit a top back here in May, I think it was, and it's basically gone sideways. But at the end of the day, the charts all look really similar. They go up together and they go down together. Okay, just as a general kind of way of thinking about it. Bigcharts.com I used to use a lot, and I don't really do it anymore, but there's one really simple, valuable piece of data that you can get from Big Charts. So I did the chart this way so that you could kind of see exactly what I do. It's Big Charts is a market watch website. So if you go to bigcharts.com, you type in SPX up here in the search box. You hit Advanced Chart. Okay. This is what you'll get. You want to compare to. Hit that Compare To tab, right? So you already have SPX, which is the C fund in there. You hit the Compare To tab, and in the symbols, you add EFA, which is the I fund, and VXF, which is the ETF for the S fund. Okay. What that gives you is an actual percentage comparison chart. Okay, so let me zoom in on that a little bit. So this is the, I guess it's about 1 year, of the three funds compared to each other. So the C fund is black. It's up since, it's a 1 year chart. So the C fund is up, 27%, right? The S fund is up 14% or whatever whenever I pulled up this chart, and the I fund was up a little bit under 10%. They still all generally go in the same direction, but on a percentage basis, obviously the C fund did way better for the year on a percentage basis than the S or the I fund, right? Okay. That's like a 1 year view of it. Actually, let's see. So you can see the S fund did way better early in 2021 and then topped basically here in February. The C fund didn't do as well in the beginning on a percentage basis. The I fund and C fund basically had a similar, and then there was a divergence, and then there's a big divergence, right? I went negative, C and S kept going higher. So that's a way that you can kind of compare. If you do the percentage comparison chart, when you see the divergences, is another way you could use this chart to make reallocation decisions. So if you wanted to move, let's say, back here is where we're starting, so they're all at the same place. If you see that the S fund is moving significantly higher than the other two, maybe this is where you want to go to 100% S. If you see that like right here is another inflection point, right? The C and S kept moving higher and the I fund kept going lower. So you probably want to be out of the I fund if you're using this kind of methodology. That's when would be a trigger to get out of the I fund. But again, they generally, the what you're seeing, right, is that they all kind of move in the same general direction together. So if you don't want to try to pick which fund to be in versus the other ones, just evenly distribute between the three, which is why I generally do that. Okay, this is a 3-month view of it. So if they started at the same point 3 months ago, they're moving generally in the same kind of pattern, right? You got a pretty good inflection point right there. I fund went flat, CNS kept moving higher, right? And then we got a really good inflection point right here, as we all know, because the S fund tanked, the C fund stayed flat, and the I fund tanked along with the S fund. So then we bottomed out, ran back up the last couple of weeks, and the C fund is still more or less flat. And in the last couple of days, the S has rolled over. So that's how you compare them to each other. And that's kind of the technical analysis way of being able to visually see which ones are outperforming the others. The last way that I tend to use a lot is in stock charts. So if you go to stockcharts.com and you put in $SPX is our C fund, $DWCPF is the S fund. So what you're doing is a relative strength line. This chart is a relative strength chart of the C fund versus the S fund. So if we're just looking at the C and the S, they were basically flat. So the C fund was outperforming the S a little bit, right, throughout 2019 into 2020. Then the S fund had a huge move relative to the C fund, right? And it peaked out in February, which is consistent with the other charts we were looking at. Since then, the C fund, the C fund underperformed in 2020. So I got a little confused on my chart here because it's 3 years and I'm not used to looking at that. S fund or C fund way outperformed the S fund here, and then the C fund is underperforming, right? Because if the C fund is in the numerator, when the line goes down, the C fund is underperforming. Right, so the S fund is outperforming the C fund until February, and then the C fund starts outperforming the S fund again. And then, as we know, in the last couple of weeks, the S fund tanked, which makes the C fund way outperforming the S fund. All right, so the relative strength line is pretty useful. I think it's more useful than the comparison charts, but taking both of them together, that's a good way to do it. So if you wanted to kind of apply the technical analysis like we do, you could say, all right, I'm looking at this relative strength chart. We have a basing pattern here basically in the relative strength line. So once we broke through above this prior high, the C fund is clearly the place to be versus the S fund, right? Okay, does that make sense? Okay, so I don't know if that tells you, certainly doesn't tell you exactly which fund to be in at which time, but it shows you how to use technical analysis to make your own decisions about which fund you want to be in.
Yeah, and I think a lot of people are going to get bent around the fact that, like, if you use that method, you're obviously not going to get every little piece you could out of the right fund at the right time. And
right.
Well, that's not our fault, right? I mean, there's 2 moves a month.
Right.
You know, got to have it. There's so many constrictions. What you're trying to do is be on the right side of the trend. Yeah. And, you know, I mean, a lot of people have gotten caught up in this fact that they've performed better just because they happen to be in the fund at the right time.
Sure. Yeah.
That's, you know, great. You didn't plan that. So what we're trying to do is plan and get it as best we can to be on the right side of the trend. Yeah. And there's not much more you can ask for that. And anybody that's a fund manager or, you know, that understands the bigger strategic picture is going to say the same thing. They're going to be like, all you can do is try to be on the right side of the trend. Yeah. For a long time. I
mean, if you're using technical analysis, yes. If you're using fundamental analysis, let's say, you can say, all right, I did the work to figure out the earnings going forward into 2022, let's say. And my projection is that earnings are up, 20% next year, and so therefore I'm going to stay in the stock funds. And as I break down the stocks in the C fund versus the S fund versus the I fund, I think the S fund is going to outperform because the earnings in those companies are better than the others. That's another way to do it. Mm. It's still not like getting out. It's not timing the market. It's a different way of basically articulating the same thing, of trying to be on the right side of the market. Right. It's okay. I mean, when we say like nobody has a crystal ball, like that is the truest thing ever. I mean, I'm actually writing the little email that's going to go out this weekend, and that's like the title of it. No one has a crystal ball, right? The 10 of the biggest financial firms in the world just came out with their 22 estimates for the S&P 500. And they range basically from 4,400 which means we'd be lower next year than we are right now, to like 5,200, I think, is the high. And that's a pretty big range. And to say that next year was going to end lower than this year is going to end, I mean, that's saying something, right? And these are like and the range is pretty big. And these are everything from, JPMorgan to Wells Fargo to BlackRock. Everybody has their opinion of what's going to happen.
They leave themselves some wiggle room in there, though.
Oh, yeah.
On purpose. We know that they, make that range broad. But the fact that they're even considering the fact that it, could be lower. Because it could. It
certainly could. And I just don't play in the game of trying to anticipate. I mean, I would never put out a number. I could use a Fibonacci extension and say, well, if it hits this target, this is where an area that I think it might sort of level off at or something like that. But it's just different ways of doing it. No one has a crystal ball.
Yeah.
It's just the way it is, including Warren Buffett.
Berkshire Hathaway.
So if you don't know about Berkshire Hathaway, there's a Class A and a Class B. The Class A, look at this real quick. All right, I don't want to give it away. The Class A basically was his original fund, Berkshire Hathaway. And so now if you wanted to buy into it, it's like almost $50,000 a share. And I don't think you can buy fractionals of Berkshire Hathaway. So there are people like, I don't know actually if you can, because now fractional shares is like a new thing. It used to be, he used to do this annual, shareholder meeting in Omaha, Nebraska every year. He still does, but people would buy one share of Berkshire Hathaway
just to go see that,
just to be able to go to that. Yeah.
That's a heck of an admittance price, but
that's exactly what it is.
Yeah.
I mean, if you want
$50,000 to go listen to him,
go listen to him talk, and you own one share of his company.
Yeah, I got about 10 shares.
Nice.
you know better than that. Fractional shares.
Well, so that's what
of Class C stock.
Yeah. So there's a Class B, and the Class B is basically this. It's a similar number, but it's like divided by 100. So instead of it's like 430 a share instead of 43,000.
More reasonable, but you don't get invited to the meeting.
You don't get to go to the meeting. No. But so you would think that Berkshire Hathaway, this is the company that is the umbrella for all the companies that Warren Buffett owns.
Yeah, big companies. Coke.
Huge, right? You would think he's the best investor in the world, arguably, right? And he is. It's not arguable. I mean, the guy's awesome. Now, that's the chart of Berkshire Hathaway A shares, right? Since what is it? It's a 2-year weekly chart of Berkshire Hathaway, right? What does the chart look like to you compared to the TSP funds? If you had a, we're going to see it in a minute because the next piece is the 2-year weekly charts for the TSP fund. That looks the most to me like the I fund. Mm-hmm. I mean, for us, the C fund didn't have a peak like this, right? It kept going like that throughout 21. The S fund peaked back here in February and was sort of volatile in a similar kind of way and went flat. The I fund, I think, looks the most like this, and we'll take a look. But the bottom line of this one is it doesn't go up in a straight line. They took the same correction back here in COVID like everybody else did, had the run up like the other funds did post-COVID, and had some kind of huge consolidation here for most of 2021. Like virtually the entire stock world has been sideways, except for the S&P 500.
Yeah, and I think another thing that gets lost a lot of times about when we talk about people like Warren Buffett, and there was an article that came out yesterday or day before about a guy who no one's ever heard of. His last name is Kidd. I can't remember his first name because he doesn't do. You'd be lucky to find a picture of him on the internet, right? He's been around just as long. He's in his 80s or 90s, and he's outperformed Warren Buffett, but in a different way, right? And when you go through the article, like it reminds me of this fellow and Warren Buffett. Basically, they're buying companies, though, right? So they're going in. They're not just buying companies; they're investing in companies. So they say to themselves, "Okay, we're meeting the management team. We're looking at their products. We're looking at the realistic, expectations of this over the next 30 or 40 years." Yep. That's not what the average retail investor gets to do.
No.
Right. And so what really drives me crazy is when someone tries to compare what we're doing, and I don't just mean Jerry and I mean you guys watching this, because we're all retail investors. Yep. I mean, we're accredited investors because we have our Series 65. Like, that's a magic little thing, and boom, now we can invest in stuff that someone else can't. Right. But at the end of the day, we're still not them.
No.
Right?
Not going to be.
Yeah, you're not. So, some of the holdings of both Berkshire Hathaway, I'm pretty sure, and the other one that I just can't remember the name of, but if you want to look him up, his last name is KIDD. A big portion of his portfolio, like 30%, is privately held companies. They're not even so. That's just not apples and apples, right? Comparing what the average retail investor has to do to be able to make money in the stock market is not what Warren Buffett is doing. And when Warren Buffett gives out advice that says, get in an index fund and stay in it forever, it's because he knows the average retail investor is not going to get educated.
Right.
And he's not calling you dumb.
No, you don't have access to the information that he has. It's not, and you don't have to buy the company to know the company. And then when you see, because a lot of people do this, they try to watch what Warren Buffett buys and sells and sort of ride those coattails, because why would you recreate the information when he does it for you, right? So, I mean, you can.
Well, amazing how that works. They're validating their decision based off what Warren Buffett does.
Sure.
Yeah.
Now he's doing it for a lot of different reasons, and he can't articulate it.
Yeah, he's not
why
going
he
to.
does what he does, right?
Yeah.
But
I mean, the point is like if you're getting educated and you're using someone like Warren Buffett or Berkshire Hathaway as your validation point, that's a great tool, right?
Yeah,
Get educated and use people that are doing something similar to be like, okay, am I making a good decision here? Does that sound familiar?
Yeah, sounds familiar to me. I mean, the thing that in his and it's not bad advice, certainly not to say like his thing is basically a 70-30 split, right? Be 70% in a S&P 500 fund and 30% in a bond fund, and let it ride, because unless you want to get educated and all that.
Yeah, if you want to be an active investor, that's a different answer, and I've heard him answer the question that way. Mm-hmm. Yep. That one always gets glazed over. Yeah. Right. But because everybody wants to hear the simple talking point, which is, go get an index fund, buy some bond and just let it go, and you're going to do better than if you did nothing.
Sure.
Yeah, and you're going to do reasonably well. But the point is like it's all in the nuances, right? It's the devil's in the details, and we always used to kind of skim over those, especially the regular financial media.
And it depends a lot on where you are in your career, your life, or whatever.
Absolutely.
I mean, if you are, 50 or older, and you're only in TSP, so your only options are the 3 stock funds and a bond fund. If you take a 50% hit, like you can't make it back.
Right.
I mean, I just don't understand how people don't see the importance of downside protection as you get.
We are Americans are notoriously short-sighted.
Yeah, that's for sure.
We act like 2008 never happened, and there was at least two. Well, there was 2 of those in our career.
Yeah, sure.
2 of them in our career of 30 years in the government.
And not counting COVID, which is a 35% hit.
Right. I'm talking about the 50% level.
Yeah, right.
Of half your account. And so many people just kind of glaze over that. And I'm like, well, okay, if you're just starting your career, could you expect to see 2 or 3 of these large, downturns? Yeah, historically. I mean, I'm not making them history.
Right.
It happened. Yeah. And it happened before, too. Yeah. So, the last 30 years of our career, which is all we have to base it on, right? Yeah. We have to do that. It still just flat out amazes me that people just want to glaze over that like it was no big deal. Well, I recovered. I mean, I don't really call it a recovery if I get back to where I was 3-4 years later.
Yeah.
I don't know.
But again, like you've said before, like if your plan is to leave it at 70-30 or some other, 50C, 50S, whatever you want to do. If your plan is to leave it there, then great. I don't know what you're arguing.
Well, that's it. So leave it there and go play golf.
Yeah, right.
Or something, backgammon. I don't know, but why argue about it? Because you're not doing.
Yeah, it's fixed. You're going to take whatever the market gives you.
Yeah.
And you can get the gains, and you'll have to take the losses. And that's when people really get in trouble, because the market will go up for a long time, and everyone's like 50C, 50S, whatever. The market never goes down, and when it does, and you're off 10% or 20%, and you're like, all right, that's fine. It'll come back. And it keeps going down. At some point, you've either gone off and played golf and you're literally not watching it, which is probably the best thing because, well, I say it's the best thing. It's a horrible thing because if you're using your your retirement nest egg to fund your lifestyle, and all of a sudden you've taken a 50% hit in your nest egg, you have to reevaluate your lifestyle. You might be able to say, hey, the market always comes back, and it does, and it will. It's just that in the meantime, if you have to make a mortgage payment, you might have a problem.
Right.
I mean,
yeah, I always say the market always goes up until it doesn't.
Yeah.
I mean, I think there's a country song out there like that right now.
All right. So yeah. Anyway, Warren Buffett's the chart of his company. It's not too dissimilar from the ones that we're going to look at right here. So C fund, basically gone straight up and continues to go straight up. I mean, if we take a look at the overlay, this is a MACD. It's a little bit of a different indicator. You can see it doesn't have. It's not range bound, so it doesn't give overbought and oversold. It's a different kind of an indicator. But if we take a look at MACD with a stochastic, you got way oversold here in at the beginning of the COVID crash. We stayed oversold, so price came down much more, and we stayed oversold. Right? That's what they're saying when this is a measure of the speed of price change. It doesn't mean once it gets oversold, you should start buying it. Once it ticked back up above, that was on the first big follow through. Once it got above that 50 line, you're in better shape. So once we had that breakout, you're in better shape. And again, we're on a two-year weekly chart. We've pretty much stayed. We've ridden that 10-week moving average line is the blue line. It pretty much corresponds with the 50-day moving average line. When price is above that 50-day moving average line over a 2-year weekly chart, it pays to be in the C fund. We got a couple of times in here where we close below it. But to the extent that you want to put your head in the sand and not worry about it, if you don't want to pay attention to this stuff on a daily basis, look at it once a week. And if it closes below that 50-day moving average line, that 10-week, right, that's the same thing, the blue line. If it closes below that blue line, you have to be a little bit concerned because eventually it'll close below it and keep going below it. All right. S fund doesn't look a whole lot, I don't think. Similar but different from Warren Buffett's chart. But we do, and both of them are hitting that 50-week moving average line. S fund's a little bit below it. We'll see what happens with the S fund here. It's oversold, and it's been oversold. MACD has come down quite a bit. It's still negative. We got this negative divergence right there. There's nothing really good about the S fund chart right now. It's below both the 10-week and the 50-week moving average line. There's nothing real good about it. Last week, if we zoom in, intra-week, right, we got down. At least we didn't close lower than last week's low, right? We moved up a little bit, poked above the 50-week moving average line, and then closed below it. So we're back in the trading range, and we'll just have to watch and see what happens with the S fund. I fund, I think, looks pretty much exactly like Warren Buffett's chart, which I think is kind of ironic because the I fund is what everybody shuns as the sort of the stepchild of the TSP funds, which I think is interesting. I fund closed above its 50-week moving average line, which is good. Hit resistance at the 10-week, so we'll see if it can poke back above there. It is trying to get back above that 50 line, so to get back from being oversold. MACD still does not look good, but we'll see how it goes. F fund, again, we've been talking about it forever, but F fund's not where you want to be if the stock funds are going up, and the F fund is almost 100% aligned with interest rates, which who knows what the Fed's got to be doing going forward, whether or not rates go up or rates go down. I mean, inflation is clearly a thing, and whether or not they push rates up to push inflation down, I mean, I don't know. You can go back and read the books from the 70s. My dad talks about it all the time. Paul Volcker, inflation was, I think he bought his first house like, he paid like 15% interest on a house. And he also bought some bonds back then when bond prices were at 15%, right? So there are times when you can make a lot of money buying bonds.
Mm-hmm.
So anyway, F fund is not a place that I would want to be right now. Questions.
If you have questions, please put them in the comment section wherever you find this. You found it YouTube, Facebook, on our website.
Yep.
Trying to figure out where we put it at. And if you find anything valuable in here, please share it with your friends. I would recommend going back and kind of taking another look at, if you've watched this, go back and take a look at the reallocation or allocation
tab on the site.
No. On the allocation, the part where you talk about how you allocate across the funds, because that is important for you to really understand why we spread it out, or sometimes we don't. Yep. Right, and so kind of understand those mechanisms, and it'll make sense to you, so you can make those decisions for yourself.
Yeah. If you, we're going to talk about it on the members only webinar also, but the S fund broke out on November 4th. Right, exploded higher. Now it rolled over, but that breakout basically was a ton of potential energy, because you had a 7 to 8 month long consolidation, and it broke out to the upside. So at that point, if it had continued higher on a percentage basis, it more likely than not would have outperformed the C fund, because the C fund had already been going up for so long. It didn't have that potential energy kind of built in that the S fund had. Right. That was the rationale for moving from, because at the time I was 100% C, to moving to 50C, 50S. That was the rationale for that, because I expected the C fund to outperform, or the S fund to outperform, based on those characteristics of that chart. It didn't happen, but I'm not the only one that thought that.
Yeah, a lot of folks did. Yeah. All right. Well, that's what we got for this week, and make sure to check in with us every weekend, 6:30 p.m. on Sundays. And we are out of here.
All right.